You know that place you want to go to when you want to spend a lot of money and then all of a sudden it just appears at your door with a bunch of boxes? You know what we're talking about. We're talking about Amazon today. By popular demand and by questions in the last Google stock analysis that we did. Hey, I want to know about Amazon, and we want to look under the hood, and that's exactly what we're doing in today's video. They just announced a 20-for-1 stock split. In fact, Amazon has not done this since the dot-com boom of the early 2000s. The stocks will be split on June 3rd, and the trading with the new price will begin on June 6th of this year. So let's go under the hood. Let's show me the money on Amazon. So first things first, if you don't know what the heck a stock split is and you always wanted to know, let me just give you a brief rundown of what the heck that is. You got a pizza. Don't make fun of my pizza drawing. So there's the crust. We're gonna throw a few pepperonis on it. Okay, let's say you bought this pizza for a total of $20 and then you decide, you know, I am not up for eating the entire freaking pizza tonight, so I'm gonna split it up, and then that way I can have some tonight and some tomorrow. So what you do is you split up the pie. Now, when you're doing this, the value of the pie, aka the $20, is still $20. You paid $20 for the piece of pie, you cut it up, and the value of the pizza is still $20. That's ultimately what's happening here, where this is Amazon, right? And Amazon has one share, okay? One share will now be split into 20 different pieces of the pizza. The value does not change. So what that means is if you invested $20 into Amazon, what'll happen after June 3rd is that you'll still have $20 in Amazon, let alone any market fluctuations. For now, what you'll have is multiple shares of the same pie. So what'll happen on June 6th, when this is now trading at many more shares that people own, 20-1, the same thing will happen with the price. So right now, as of the recording of this video, Amazon's going for $3,038. What we could then assume is if you take 3038 divided by 20, that means it's going to go for $151.90 per share starting on June 6th. But remember, because you owned one share, the value that you have invested is still there. You just have now 20 shares instead of one share of Amazon. That's how a stock split works. But why would they do that? Well, back in the day, you used to have to buy a full share. Now, Robinhood, Webull, places like that, they allow you to buy fractional shares. But in the past, you had to, if you wanted to buy any type of stock of Amazon or Google or something like that, you had to put up the entire amount of what one share cost. So as of today, $3,038 would have to be put up in order to buy one share of Amazon. That's a lot of money, and if you don't have $3,000 to invest, you're kind of screwed. You want to buy Amazon, but you can't. So what they used to do is they would do a stock split to bring the overall price down. The people that currently own the shares would have more shares, but it would help reduce the cost. That's more attractive to investors. So what are investors going to do? They're going to be more likely to buy because they may have $151.90 on them. As a company continues to grow and get strong, they can go through a lot of different stock splits. In fact, that's a very good sign of a healthy company that they have the ability to stock split so many times. So here we are. We got the PE ratio, revenue, profit margin, debt, earnings per share, and shares outstanding. We're going to go through this entire thing and see if Amazon is worth it or it might be a little bit concerning. Now, as of right now, on Yahoo Finance, they actually have this rated as overvalued, which means that we're valuing Amazon a little bit more than what the price and the metrics actually represent. So that's quite interesting, and it actually starts with, right there it is, the PE ratio of 46.97. Now, if you did watch my past video on Google, you may remember that was a lot less. The Google PE ratio was at a 23.17. That was actually really good, and finance.yahoo.com indicated that Google was undervalued. So it's very interesting that Amazon PE, price to earnings, a little bit high, a little bit overvalued. So as a result of that, on our first metric here, we're gonna give a PE ratio a yellow light because that is a little bit high. Now that's not soaring. If that was in the 100s, that would turn into a red light, like, oh, that's not good. But I'll give it a yellow because even though it's not in the range of where we like it to be, anywhere from 13 to 18, or at the most 20, it is something to keep our eye on, especially after the stock split. For the next ones though, what we're gonna do is we're gonna use again our Webull account and look at the revenue, profit margin, debt, and things like that. You got to check out Webull. Webull is a brokerage that has commission-free trades. It doesn't cost anything to download the app. And right now they're giving you up to 5 free stocks. Get ready for this. That could be valued up to $9,600. Here's exactly how it works. When you download and create an account with Webull, you will get 2 free stocks, and they're worth anywhere between $3 all the way up to $300. Then when you make an initial deposit of any amount, even 1 penny, to trade in the stock market or the crypto market, you'll then get another 3 stocks. Those 3 stocks each will be worth anywhere between $7 and $3,000. Click the link in the description below to get Webull today, and when you do that, you can then follow along with what I'm about to show you in regards to Amazon stock. So in your app, go over to the magnifying glass. We're going to type in Amazon. You can type it in as this, Amazon, or AMZN. That is the ticker symbol for Amazon. We're going to click on that. We're going to go to the company tab right here on the right-hand side. And then we're going to click on the bottom where it says financial details. First thing up is revenue. We want to scroll down here to where we see the income statement, and we're going to click on total revenue. What we want to see is for this to keep going up, up, up. 2017, we have 177 billion, followed by 2018 at 232, 2019 at 280, 2020, 386, and 2021 at a remarkable $469 billion of revenue. Guess what that means? That means Amazon's looking pretty darn sexy in the revenue category and gives them a green light in that particular example. Now, that is pretty damn good. I mean, what a surge to, what is the pandemic, right? You got 280 billion. So you're hanging out in like the high ones, low 200 billions, and then you shoot up to 386 and 469. Obviously, with people at home, they're going to rely more on Amazon to deliver their products to them. Pretty darn good. Not only that, their Prime streaming service continues to grow. That's what we want to see. But let's see, are they making any profit on all that revenue? In order to do that, we take the net income right here and we divide that by the total revenue. So net income, you can see, is 33.36 billion. All you got to do, take your calculator out, type in 33.36 divided by total revenue, which is 469.82. That gives us a total profit margin of only 7.1%. That's actually pretty darn stinky, giving them a yellow light in profit margin. Let me explain. When we looked at Google, they had a very significant profit margin. In fact, let me look at what it was, just because I don't remember off the top of my head. 29.5%. Whereas 7.1% in Amazon is pretty low. Now, of course, they have a lot of retail to deal with, so naturally that might be an issue. But look at this. So you have total revenue of 469 billion, but your net income is only 33 billion. What's going on with all the other money? So profit margin is looking a little bit meh, so yellow light. Let's talk about debt. What is their debt load? So if you go down here to the balance sheet, we're looking at overall assets versus liabilities. Now, assets at 420 billion and their liabilities is only 282. You can see they've actually improved that significantly over the period of time. In 2017, they only had 131 of assets and 103 of liabilities, which means they had a very scary 78% balance sheet. I like to see things below a 50% or around a 50%. So even though we are still at a 67%, it is nice that one, it is starting to go down as far as the overall debt to asset ratio. But I do want to see that get to 50%. Not that I want to get into the idea of comparison in this video, but because they're both doing a stock split, if you compare that to Google, Google has a 29% debt to asset ratio versus a 67% on Amazon. So I'm going to say that's a yellow light as well. Maybe it could be a little bit of a red light. But the reason I want to say it's a yellow light is because they are reducing down that overall percentage. If the percentage was flat or increasing, that would be an automatic red light, but I'll give them a break. Let's go up to earnings per share. You can see that even though Q3 2021 did look a little bit dicey as far as the estimate versus the actual, indicated by the gray line is the estimate and the blue line is the actual. You can see they made up for it plus some in Q4 of 2021. That looks pretty darn good to me, and I would say the earnings per share gives them a green light. Now, for the last one, This is something I wish Webull would improve upon very, very soon. That would be very nice. But we do have to hop over to Yahoo Finance for this last piece, and we want to see their shares outstanding continuing to go down. We don't want to over dilute the market with a bunch of shares outstanding. We want them to buy that back. Now, here's a key point though, as far as some recent news. If we go over to the announcement right here, CNBC, not only a 20-for-1 stock split, but they are going to do a $10 billion buyback. That's a good thing. That's what we want to see in any company that's doing well. So good job that you're using some of your net income for a buyback and some of your revenue for a buyback. That's going to reduce the overall shares outstanding, which always positively influences the price. So let's see where they are before all of this occurs. If we go over here to the financial tab of Amazon on Yahoo Finance, go to the balance sheet, look down below, we can see that overall ordinary shares has gone from 491 to 498 to 503 to 509. That continues to go up. That is not what we want to see. They're continuing to issue more shares as opposed to going the other way and doing a buyback. Now, once this buyback occurs as a result of the stock split, this should hopefully look like it's decreasing considering post stock split. Okay, so with shares outstanding, I'm going to give that one there a yellow light as well. Again, I could be evil and say it's a red, but because they did announce a buyback, I'll give them a little bit of a credit. So here's what we're looking at. Now, you got a yellow, a green, a yellow, yellow, green, yellow. I want to see some improvement on their profit margin. I want to see continued improvement on their debt load. Get that below 50%. And that's just something I personally look for. That's not some guru. That's just me. And I'm just some guy on YouTube who sometimes looks like Woody from Toy Story. You got to do your own research. I'm just showing you how I do it. I think focusing on profit margin, debt, and shares outstanding will help overall in the long term with their PE ratio, turning this to a green light. That's what I want to see. So overall, what do you think about Amazon? Are you excited for the stock split? Or are you going to wait till after the stock split to maybe consider what their fundamentals look like? Comment down below, let me know. Check out this video next, and we'll see you on the next video.